and welcome back. I hope you're all doing really well. I thank you again for the love and support on the most recent video. Seriously appreciate it. If you haven't actually seen that video yet, I do urge you to check that one out. That is, of course, relating to Web3 domains over on Hedera. So the .hbar domains are now live. In its current form, they can be used in order to proxy Hedera addresses, making it easy to transfer crypto to wallets that you already know. And of course, in the future, as more providers come online, operators like Web23 will enable proxying of those domains to Web2 surface level domains as well. Lots of different stuff happening, and I'll be covering that in more detail once it does go live. However, for now, you can actually mint .hbar domains via hashgraph.name, and that video looks at what's going on in more detail. Anyway, this video is going to have a ton of different crypto news and of course Hedera related content as well. But first things first, I want to take a quick look at what is going to be happening over the coming week or so with the Federal Open Market Committee, or the FOMC, and relating to what the Fed will be doing in terms of interest rates and their policy going forward. As we all know, those macro plays are of course incredibly important to the crypto and equity markets alike, and will be setting the tone towards the end of the year. The Federal Reserve is of course expected to hike interest rates again by another 75 basis points, but it does hint at a future rate hike that will drive the markets. The central bank's two-day meeting takes place over a week on Tuesday and Wednesday, where investors will be on high alert for more guidance on corporate earnings ahead of the next reporting season in October. Markets stirred on Thursday after the FedEx withdrew its full-year earnings guidance and warnings about a global softening in its delivery business. The stocks were sharply lower in the week, ending the S&P 500 at 3873, which was down 4.8% and its worst week since June. And we had some bad days as well, some of the worst days we'd seen since 2020. And of course, a lot of this came out from those initial CPI figures that showed that inflation hadn't actually continued its downward trajectory from July into August. We saw a small increase, and that has spooked markets. We see here the highlighted text that I've got. Majority of the markets were pricing in a 4% terminal rate as of April, I believe, next year. So the terminal rate effectively being the highest interest rate that we'd see during this market cycle. And unfortunately now, because of that information we've received from the CPI reports, this is now effectively an upper limit of 4.5%, showing that the markets are now pricing in the Fed is going to continue its very hawkish and aggressive interest rate hike policy for a sustained period of time in order to combat inflation, which is of course part of the mandate that Jerome Powell has been talking about for quite a while. Now, this could cause further pain throughout the markets into the future, particularly the short term, looking at the next 6 to 12 month period until we really see inflation come under control of the Fed. This will continue, and of course this further prolongs that risk-off attitude we're seeing from the majority of investors and institutions alike, which of course command a majority of the money. Of course, I'm still just averaging into those positions. Hbar for me at the moment is at a brilliant price, severely undervalued. Also tokens like Quant, for example. Check out my previous videos in terms of what I've been talking about for tokens. I want to do a quick segment as well, talking about what is happening with Ethereum at the moment. Obviously, the merge has finally taken place, and obviously many people are now looking at, okay, well, what's happened in terms of the news and differences. There doesn't appear to have been any issues, which is always a good thing from this merge. However, the merge is a change of consensus mechanism and not an expansion of network capacity. And many people are asking, okay, when will there be lower gas fees? And I see this narrative that other layer ones are now dead because of this move from proof of work to proof of stake. It was just a consensus mechanism change and will not result in lower gas fees, particularly in comparison to networks like Hedera, which has the lowest across all layer ones. There are many other efficient layer one solutions. Ethereum has moved to proof of stake, which makes things more energy efficient, okay, 99% more energy efficient, but it doesn't make things cheaper. And we can see that from these Ethereum gas charts here. So, okay, at the moment, we're still at a low gas price, but we still see the spikes happening in and around the merge. Nothing has happened to the long-term trajectory just yet for the Ethereum gas fees. We can see the average gas fee at the moment is about 𝗟𝗚𝗙𝗚, and depending on which platform you're sort of minting or transacting on, we can still see gas fees around 50 cents, $1 there, USDT transfers at 30 cents. This is still a far cry away from Hedera's 0.0001 fixed gas fees, and then not to mention things like scalability as well for Ethereum. Those challenges still have not been solved The merge has only solved the energy efficiency. Jumping across then, Japanese financial service giant SBI has received regulatory approval to offer its crypto services in Singapore. So again, we're seeing that further expansion throughout the APAC region for crypto services, and this is going to be great for adoption in the long run. We've also got the SEC chair, 𝗟𝗚𝗙𝗡𝗦𝗧𝗔𝗠𝗦𝗧𝗔𝗠𝗡, reckons staking services look similar to lending, just rebranded. This is obviously not great. Ethereum merge attracts SEC attention as Ethereum drops 8%. And we're talking about here, I wanted to quickly dive into what he was trying to allude to, and it's literally outlined in this article here. So lending, staking, and earning rewards as defined by the 1946 Howey test could constitute security activity, the Wall Street Journal first reported Thursday, citing comments made by the SEC chair to reporters after congressional hearings. The price of Ether has dropped up to 9% since, now trading at $1,460, while Bitcoin shed just 1%. Both Bitcoin and Ether may yet be regulated more by the more amenable Commodity Futures Trading Commission, CFTC, should a group of bipartisan senators get their way, but certainty over how security laws maps to cryptocurrencies is still hotly debated. Now, obviously, this is as far as the news has gone at the moment. Hopefully, we don't see any more pressure from the SEC regarding Ethereum. That would be a major blow to cryptocurrencies across the board. We've obviously still got that ongoing SEC trial / investigation, whatever you want to call it, with XRP, and that has seriously dented the price and progression of that particular project. We don't want to see that bleed over into other layer ones. Another major update from Saucerswap Labs has just gone live. Their analytics V2 page has finally dropped, and it does look very good. We'll be looking at it in a second, but liquidity, volume, and price charts are now available for all listed tokens and pairs on Saucerswap. You can check it out over here. We'll have a look. And of course, special mention to Iron from the community for having that massive Google Docs spreadsheet, which was tracking all the prices for the last sort of few weeks. Not only that, the Saucerswap token menu was also updated. We've got an enhanced UI, common bases, easier to manage custom token lists. Token balances now feature inside this list, as well as a scroll bar. This token menu pairs perfectly with today's Analytics V2 release, wine and cheese. But we can see here how sort of improved this looks over what we've seen previously. You can now see your balance when you're selecting these tokens, and progression is really starting to look good. If I jump across, this is the Saucerswap analytics page. I will of course leave this link down in the description, but you can navigate to it from the Saucerswap Finance website. Here we can see total liquidity statistics over time. We've got volume over time as well. You've got the different tokens and pools that are currently live. So if I jump into tokens here, it loads. And let's say we'll look at the source token, for example. We then come into this interface. We can see the current TVL, the 24-hour volume. And then on the chart on the right-hand side, we've got different sort of metrics we can flick between. So we can look at the liquidity over the last week, month, and all-time period. Now, of course, be aware, the all-time period reporting is the information that the Saucerswap API provides. So it'll only go back as far as when Saucerswap actually launched, which is obviously fine for majority of HTS tokens. Not so great, for example, Hbar, where obviously we've got price history that goes back several years. We can also look at volume and then price as well. We've got candlestick chart view for the all-time. We can also flick this across into line or area chart view, where we can see the different price action happening. This is fantastic to be tracking the price of particular tokens. So we can see at the moment, for example, Saucerswap all-time high was around the 8th of August, which was when the platform, just after the platform pretty much launched, a few days after, where we hit around 6 cents, and we're now down here somewhere around 2.5 cents. I'm still obviously buying Saucers tokens. It's one of my favorite across the different the Hedera token service tokens, HTS tokens. Anyway, jumping across and staying on the theme of DEXs, Hbar Security have just conducted the Hbar Suite audit. Now, of course, Hbar Suite is something I've featured many different times on the channel. These guys are building a decentralized exchange using smart node technology, which leverages both the HCS, the Hedera Consensus Service, and the HTS, the Hedera Token Service. Hbar are thrilled to announce they have successfully completed the audit of Hbar Suite, where of course security is always a priority. This is fantastic to see. This is a huge document listed over on their GitHub repository, but I wanted to quickly take a look at the security analysis breakdown. So we can see there are only 2 high risk levels found within Hbar Suite, which of course have been solved already, and that was duplicated pools being created. So fair enough, high risk, but not detrimental to the end user in terms of loss of funds or anything like that. and then pools becoming unavailable was security analysis point number 2. There are a few medium ones as well. Large values in input fields can cause site crashes, unauthenticated cache purging, launchpad purchase pairing swaps, and USDC decimals being medium. Some other low risk issues there as well that have of course been solved. And then there's some informational things like developer logs, open ports, and historical IP information, which has of course been acknowledged by the team. But from what I can tell from this audit report at first glance, everything looks to be in order by the Hbar Suite team, and hopefully they'll be looking to gear up for a launch. There was some other interesting information as well. 𝗟𝗚𝗡𝗙𝗦𝗧𝗔𝗠𝗦𝗧𝗔𝗠𝗠𝗣 let slip and posted on Twitter. The first DEX in history to achieve zero slippage effect is going to be the H Suite platform. And of course, that is because of that smart node technology, which is built directly off the back of the Hedera hash graph consensus algorithm. We can see, hello future, today is the day we make history. Our Hellborn audit report is live. So what did we actually achieve that no DEX in history has ever achieved? Smart contractless, yes, but also zero slippage effects. The zero slippage effect is a consequence of our novel smart rebalance market maker, or SRMM, algorithm that we have been working hard on. So this looks really interesting, and I would love to be diving into this when it does go live on the mainnet to see how this works in reality. But this could be an absolute game changer, and of course will continue to do very well on the Hedera ecosystem. The more DEXs that we have available, the more choice there is for end users, and the more volume we will see across the protocols. Not only that, those Hbar Suite tokens are still available. I do have a video talking about how to buy tokens from their round 1 initial sort of coin offering. Round 2 is still live, and there are some tokens left. And of course, you can still buy those tokens as well on the Saucerswap platform. That is, of course, the beauty of decentralized finance. There are multiple different places that you can get hold of these tokens ahead of their launch. I think they'll do very well into the future. Jumping across and looking at the last piece of news as well, the smart node makes no use of databases. The HCS, or the consensus service, is our database and our mainstream event engine as well. By doing so, we don't just avoid any sync or propagation data issues, but we make sure our smart nodes are faster and lighter by fully relying on the layer 1 itself. Of course, Hedera, there are no smart contracts facilitating any of the transactions on the Hbar Suite platform. And this is going to be one hell of a journey once it does actually go live. Also looking at state of Hedera in one of their recent update threads, they are also partnering with Helium, and I believe they've got some information from Hbar Suite as well, when it will come more HBarX yield opportunities coming with Helium. So it's all happening across all the different DEXs at the moment, which is great to see. Stader also released an article talking about CeFi, or centralized finance, versus DeFi, decentralized finance, and why people would choose one over the other. So obviously, what is centralized finance? Traditional form, centralized exchanges. I'm sure many of us are aware of that. And the same being said for decentralized finance, which is obviously DeFi, where all the financial products and services are basically built on blockchain technology. So the comparison between them, I want to run through these because it is a very well summaried thread. Transparency: the DeFi app codes might not have always been open source, but their execution has to be publicly verifiable on the blockchain. Hence, unlike on CeFi, DeFi users can actually observe and verify the execution of DeFi state changes. Such transparency instills trust in users and gives DeFi technology an undisputed edge over CeFi. Atomicity. A blockchain transaction allows for sequential actions to be performed. The entire combination of these actions can be made atomic. That is, all transactions will either get completed together or failed collectively. This programmable atomicity feature does not exist in the CeFi, as it's expensive and attracts slow legal agreements. Custody as well. DeFi is known for allowing users to have direct control over their assets anytime, anywhere. Not your keys, not your crypto. Crypto trading, so centralized exchanges share the same foundations as other traditional financial technologies like the limit order books, etc., while decentralized exchanges function in an altogether different manner. They use automated market makers, or AMM protocols, to determine the price according to a mathematical algorithm, all depending on the transaction volume and things like liquidity in the pools. Transaction fees, of course, as well. CeFi cannot take advantage of the transaction fees of the native layer 1 that things are built on top of. Of course, DeFi here on Hedera being those incredibly low fixed fees, you're not going to beat that with any centralized exchange. Privacy as well. DeFi is found only on blockchains that have non-privacy preserving smart contracts. Why? It offers pseudo anonymity rather than true anonymity, while centralized exchanges use the same AML policies to convert money to cryptocurrency assets. These exchanges have the power to reveal the ownership of their assets to the government or other law enforcement. It's not going to happen on DeFi. Arbitrage risks. An arbitrage must operate atomically to avoid the risk of price swings. When transaction fees are ignored, arbitrage between two dexes on the same blockchain can be deemed risk-free. This is majorly due to blockchain's feature that allows traders to write a smart contract and perform the arbitrage and would revert if the arbitrage does not return a profit to them. Inflation. Inflation is simply the depreciation of existing currency supply, which is caused by adding a new supply or the loss of currency's purchasing power. In centralized finance, the central banks maintain the power to produce fiat money, and they circulate or calculate the inflation and other indices based on a particular basket of consumer products, often called the CPI. While in the DeFi world, the asset supply of various cryptos is of course dynamic. Suppose Bitcoin has a supply hard cap, which can lead to its scarcity. Also, there is no inflation or other vulnerable factors or security instability here compared to the CeFi technologies. That one can be taken with a pinch of salt because, of course, you could measure the purchasing power of Bitcoin against traditional assets. Never-ending market hours, of course, 24/7, 365. Cross-chain services. DeFi normally does not support the service due to the complexity and delay in completing atomicity, but CeFi services solve this problem by storing the funds from different chains, which is obviously one of the benefits of having a centralized exchange. And then fiat currency conversion flexibility. Interoperability is of course better with CeFi than DeFi, but the same with fiat conversion flexibility, as it requires a centralized institution, and most of the DeFi providers do not offer fiat on-ramps. Now the takeaway here is that CeFi and DeFi offer or have different offerings, and of course it is well worth having different routes into the crypto space. Majority of the time people will opt for these decentralized platforms because, as we all know, not your keys, not your crypto. Having some kind of software or hardware wallet where you own the private key and the seed phrase, which of course you should never share, enables you to ensure that you have 100% control over your crypto, which prevents, of course, these exchanges from seizing it if it goes bust. Right then, some other really interesting news that has been circulating is to do with Helium, which is a layer 2, but talking about them running on Hedera. There's some different stuff being happening in the moment. So there was a Hedera improvement proposal published to do with Helium. So Rob Allen, also Nod Rob on Twitter, had a hand in this Helium improvement proposal that seems to be suggesting, if voted for, they will set up a governance model similar to Hedera's in structure and also use the Hedera consensus service to secure the network. This could be massive if it does actually take place. This would be one of the first huge big names moving across to Hedera and running on top of it as a layer 2. So Helium is trying to scale their network by two different options for now. Either move to Solana because it's scalable, or use the Hedera HCS and the HTS. And we all know realistically that Solana in the short term may work well for Helium, but over the long term, Hedera is the place they really want to be. Reasons for choosing Hedera Hashgraph as the DLT for this HIP. Hedera is an enterprise grade network which is built upon several key foundations. If the Helium network wants to achieve enterprise adoption, i.e. becoming the telecoms infrastructure of the future, it has to start acting like a stable and reliable partner. One of the core reasons to use this DLT as an example is the long-term thinking and focus on good governance along with stable technology. And this is one of the major praises we have seen for Hedera. Okay, it's been slow in the short term, but that is because they are looking to achieve good governance and adoption in the enterprise communities, and nothing is fast in the world of enterprise. It is full of red tape and regulation for good reason, and it's one of the adoptions that Hedera obviously receives critique for, but over the long term will prove successful in my opinion. Rounding up then, we can look at this talking about telecom. So telecom use cases on Hedera could be or going to be massive. You've got payments, identity, roaming settlements, automating workflows, fraud prevention, and much more. Council members Deutsche Telekom and Tata Communications have been building proof of concepts for a few years already. And this is off the back of a thread from Danny Eid. We're starting work on Hedera, which was from Deutsche Telekom, Tata, and IBM, all governing council members. It's really suitable for high volume throughput and the need for fast certainty as well as finality and those low transaction fees. We can see this interesting chart here. Hedera is the leading industry innovator with its hashgraph technology. With the connections here, you've got the council members, explorers, security and audit assurance, wallets and custody providers, different SDKs, token issuers, exchanges, standards and system integration. Of course, this ecosystem is continually being revamped and developed upon. Launching the token on Hedera is number one, and native wallet support thereafter. We alluded to bringing use case functionality, shipping that as soon as possible within the bands of engineering roadmap, and we're working in an agile sprint infrastructure. So layer tokens and barter liquidity pools look like they're coming. So the first thing we'll be looking at to do is the GDEX version, first version of GDEX, which will include LP staking, which allows, basic staking and rewards to bring liquidity into the wholesale space. And then they'll include the application of the Rain Man, which is our matching engine, if you'd like to use the financial markets trading analogy. So lots of good stuff coming down the roadmap for this as well. So the barter ecosystem, telecom infrastructure, decentralized. You got barter DAOs, barter protocols, layer smart tokens, all sorts of other information here. So the layer A token is where we're issuing at the moment. The prime token that gives us exposure to the ecosystem is a transactional token. Layer.A is the finite supply, 5 billion in total supply, and the layer X is a fungible transactional token, which is a variable supply. So they've got a different breakdown here of what's going on, but it's really interesting to see that we've got different projects moving into the space to build a decentralized telecom infrastructure, which of course can be leveraged potentially by a lot of these enterprise solutions out into the future. And this goes hand in hand with many of the other projects we are seeing built on top of Hedera. I hope you guys enjoyed this video. If you did, leave a like, drop a comment if you've got something to say. I do try and respond to as many of them as I possibly can. And until the next one, I'll catch you then. Cheers.